Welcome to Greystone Capital Group, where we invite you to embark on an extraordinary journey towards a life of abundance and fulfillment. At Greystone Capital Group, we specialize in the transformative power of passive investing in commercial real estate. Your journey to financial freedom and a fulfilled life begins right here. Subscribe now and let Greystone Capital Group be your guide to shaping a brighter tomorrow.
Well, welcome everyone. Today we're a wonderful guest today on my show, Whitney Elkins-Hutten, and please, thank you for coming on the show today.
Yeah, thank you so much for having me on, Jonathan. This will be fun.
It'll be fun, yes, yes. I love having guests and having great conversations and learning, learning from your perspective of passive investing and the current real estate market and the cycles for our audience. So tell us about your background, how you get started, and then we'll go into those main topics.
Absolutely. Well, so I'm the director of investor education here at passiveinvesting.com, but that's not where I started. My real estate journey starts back in about 2002 when I bought a property with a significant other. And then about a month later, the relationship fell apart and I had a house. And I learned how to be a landlord really quick, stuffed that property full of roommates to cover the bills, and then decided that, wow, if I'm going to get out from underneath this house, I need to do the rehab. And so I learned how to do flooring, drywall, electrical, plumbing, some things that I probably shouldn't be doing. And YouTube didn't exist back then. So this was all out
Oh,
of a book and Home
okay.
Depot classes. And so sold that property about 11 months later, made a good chunk of money. And I just thought I had like figured out the whole investing in real estate game. The next deal didn't go so well. And I was like, ooh, okay, there's some immutable laws to real estate, like location, location, location that I need to pay attention to.
Okay.
And
Was
then
that a single family house that you didn't do well?
yeah.
Yeah.
Oh, the reason why it didn't do well is I bought it in the mountains at the wrong time with the wrong loan. Like, so
Okay.
just
Okay.
piled on a bunch of problems all at the same time. And long story short, the next few years, did a couple more like live and flips and house hacks, got really good at building up buckets of equity, but really bad at building cash flow.
Okay.
And then eventually, like it dawned on my husband and I that we needed to figure out how to unlock those golden handcuffs. So we started scaling a portfolio of almost 40 single family rental properties.
Wow.
Then eventually went into owning multifamily property,
Yeah.
both in joint venture and then in general partner relationships.
Okay.
And all this time we're taking our income because we're still working. We're taking everything that we possibly can and investing it into our real estate strategy. But sometimes we couldn't find a deal, so we'd invest in it passively. Not only to scale the portfolio, but to get diversification into other asset classes like debt and self-storage and express car washes. And that's when it kind of dawned on us. We're like, wow. It's cool to be an active investor. It's even cooler when you can pair that with a passive strategy to help you
Okay.
diversify and grow even faster. And so where we're at today, my husband and I, we have over 6,500 residential units, 2,200 self-storage units, 15 express car washes, a myriad of other cash flowing assets. And it just really, it's afforded us the, 100% control and freedom on how we spend our time.
Wow. Well, that's amazing how you start from one a long time ago, and now you have so many assets, and you did through both strategy of active and passive because you can't do all active because you can't find every single deal every single time. So it's either you become a co-GP or you become an LP, a passive investor.
Mhm.
So tell me, what was your first passive investment that you got into?
So, and I got let go from my job. But so first of all, it has a little bit of a backstory.
Okay.
And so, I'm sitting here looking at this large chunk of change that I've built, scaled in my 401k with my work.
Okay.
And I had read Money Master the Game, the Tony Robbins book. And I'm just sitting
Okay.
here going, I have four things I can invest in through my 401k. And I was like, I want access to real estate. I want access to commodities. I'm like the squeaky wheel at work. And our benefits manager was like, love you, girl, but you got to settle down.
Okay.
Like,
Okay.
we're not going to add those investments here. I was
Oh,
like,
yes.
that sucks. Like, I can't get the diversification. And so I'm sitting here like looking at this money sitting here that's underperforming. I wanted more exposure into real estate, into other asset classes. And then, I got laid off.
Oh,
And all of a sudden, at first, like nobody's happy about being laid off. But then I was like, ding, ding, I get my 401k back. So now I could, choose to liquidate part of it if I wanted to. I can move it over to a self-directed environment. Well, so we kind of go through this whole repositioning with my 401k. I get back to buying. And then I had like probably like 50 to 70k still sitting there that I'm like, I don't know if I want to go buy another piece of property with this money, And then a friend of mine put in front of me a deal that was in multifamily, and I'm like, well, that's what I'm doing now. I know I needed to diversify outside myself into other markets, and I was like, okay. So I go into this deal in San Antonio, Texas area
okay.
with a well-known operator, a well-respected operator, and I just kind of like set it and forget it. And I was just like, it's going to be like a bond. It'll pay off one day. Like, I'm just going to kind of like leave it alone. But then when I'm sitting here trying to figure out what's the next asset I'm going to go after, I keep comparing it to this other asset that I invested in. And that's when it was like dawned on me. I'm like, wait a second. Like you can make some really good money as a limited partner investor, especially understanding the trade-off of control and time for the return that you're going to get. And
Hmm.
so that was my first kind of foray into passive investing. And, for me, I just really, understood the multifamily market. I understood residential real estate. It took me several years to kind of branch out into self-storage and other asset classes. I've yet
Hmm.
to, we were talking before the show about you investing in industrial. I haven't gone industrial yet. That's one
Yeah,
asset
yeah.
class I'm still trying to understand.
Yeah, I think it's because I done multifamily self storage. I'm an expert in self storage and multifamily, and I'm branching. I'm beginning to buy my industrial triple net stuff. And from my underwriting and my analysis, it's a lot more easier, more safer for someone like a passive investor to talk about. Because if it's really triple net, there's not much risk and responsibility as an LP because there's it's triple net. The only thing you warranty is just the roof and sometimes the structure. Now, if it's absolute triple net, that means you're zero responsible. You're more like more a passive investor. You own the property, but you're more like a passive investor because there's zero risk at all, zero, not even one penny. So that's why, in essence, it's a little easier. But the trade-off is, since it's more like a bond, your cash and cash is lower than multifamily because more is value adds more higher risk and it's a lot more moving parts. And even self-storage sometimes has risk because of certain areas, certain dynamics. So it's a little bit risky, but a little less riskier, I think, than multifamily. Yeah.
Mm.
Yes.
Yeah, and I really believe that, people should be diversified across a lot of asset classes, right?
Yes.
When you're investing as a limited partner, your first thing that you need to understand is your goals, your risk, and timeline.
Yes.
And I think from there, what can you control? Well, you can control the different layers of the capital stack that you invest in, the different
Hmm.
operators you invest with,
Hmm.
the markets, and then the deal,
Yeah.
right? So you got to, what you don't have is the operational control. And so I
Yeah.
hear you whenever you say, industrial can be like a little bit, you know, safer in a way because that operational control is now to the tenant. Like they're responsible for paying the taxes,
Yes.
the insurance, and the maintenance, and all that sort
Yes.
of stuff.
Yes.
Uh,
And
now,
the and
you
the
still
lease
have
is
to
already
underwrite the
set.
tenant.
Yes, yeah. As long as the strong credit with tenant, then you're fine. But there's a lease that's really long term, and the rent's already set. So it's not like you set the rent. It's the rent's already set, unless
Mhm,
it comes to renewal. So that's the only part where you got to deal with, and then find a new creditworthy tenant. So
mhm,
that's the only part that's risky in those triple net deals. So whereas multifamily, it's like it's a higher risk because you just don't know. Like you just don't know all these things that can happen, right? So yeah.
mhm.
So let me ask you, express car washes, what would you say why you like that asset class versus like self-storage? And what's the differences in those as a passive investor?
Yeah, so we brought express car washes on as an opportunity for investors to continue to get a higher yield in an investment and get diversification into another asset class that is backed by real estate. And I think, this is where I spend a lot of time educating investors. Express car washes in and of themselves are not real estate, but they're yet a cash flowing business that can be backed by real estate. So how we buy express car washes is that we look to buy both the business and the land from, say, a mom and pop investor. Maybe we develop it ourselves. And then you have like a pretty low overhead, high cash intensive business on that piece of land. And so you can benefit from the cash flow, you can benefit from the real estate appreciation as well. Now, the reason why we like express car washes is that, you can wash 400 or 500 cars a day with just 2 to 3 full-time employees. And, you can be all in on a car wash, say for like a couple bucks, in like, chemicals, electricity, water, labor, maintenance, all of that.
Oh,
And then, yeah, I mean, yeah, the actual, water, electricity, chemicals, you're probably looking at about like 83, 86 cents a wash if you're hyper optimized. But you got
okay.
to factor in, your CapEx, your maintenance, labor costs, stuff like that.
Hmm.
And so you're about in for like $2 a car wash, at an express facility. But whenever you can wash, 500 cars a day, and if majority of those cars are on a monthly recurring revenue membership, it can be very, produce some nice cash margins for
Okay.
investors. Now, there's different types of car washes out there. You have your coin operated car washes. That's probably the most hands off you can be. Those are the ones where you drop your coins in or you scan your credit card and you yourself are washing your own car.
Hmm.
Then you have the car washes that are attached to like gas stations and service centers. Now those are really more of a cost center, an additional cost center for that gas station. So not terribly scalable as an investment. Then you flip go the other end of the spectrum. We've got our full service car washes. They might have a short tunnel like an express car wash, but those are very labor intensive. You've got somebody at the beginning that's vacuuming out the car, maybe 3 or 4 people that are doing the vacuuming. You got somebody that's driving the car through the tunnel, and then an army of people at the end, hand drying the car.
Hmm.
Now, the express car wash right there takes advantage of marrying the automation of the self-serve car washes with a product that gives more of a full service finish. And so they can be quite lucrative. Now, they come with issues. Right now is there's a lot of scaling that's happening in the express car wash space, especially in like major metropolitan service areas.
Okay.
And so, if somebody's looking to invest passively, you want to look to invest, say, like in a secondary or maybe even a tertiary market where
Okay.
you have limited competition. I mean,
Okay.
because it's a business. It's
Yeah.
kind of like self-storage. You don't want to, be in an area of town that has, you know, 5 choices in a 1 mile radius. You want to be
Yeah.
kind of a lone wolf, so to
Yeah.
speak.
Yes. Yeah. So
So
good.
there's a
Good.
lot of opportunity here. But think about this, like most people in the United States actually own one car, and 72% of households have 3 or more cars. And so
Wow.
uh this isn't an industry that's going away.
Yes, I believe in the car wash because I know my friends here in Dallas are big on car wash, express car washes, and doing a lot of fun to make it kind of fun to do those. I think because it's technology driven, so less cost on humans. Maybe you need a cashier and that's probably it, or something like that. One person. It's not too much, not too intensive capital unless you automate everything and you get a lot of volume. That's the key. So,
Yeah, and you want to, it's not just about capturing the customer, but also keeping the customer engaged. So how do it's easier to market to the same customer over and over than it is to go attract a new customer. And
mm,
so as more and more car washes come online, you have to become incredibly savvy at how to maintain that current customer that you've already acquired. And
right.
that's where I kind of liken this is a business, and you're investing in a cash flowing business. And so the way we buy is that we always buy the underlying land. We get rid of that renting the land back to the landowner who could sell it off to a hotel development in 5 years, right? Like,
Oh,
we put some safeguards in place. We also don't require our investor to participate in any development with us. They
okay.
can, but you'll see a lot of fund managers that will require the investors to not only they have to invest in the development phase as well as the operational phase of the asset.
Okay.
So there are just some things to watch out for, but primarily competition, location, and competition. Those are going to be your two things that are really going to, hang you up. And when we talk about location, we're getting down to how many cars are going past that particular location on any given day and can make a simple right-hand turn into your facility. So it's not about being on the busiest street corner. You can be on the busiest street corner, but if nobody can access you, um, that's a problematic.
I see. Yeah, so it's kind of like in a way self-storage where you look at the access, the drive, the signage, and make sure that's easy to access and make sure that because a lot of drive-bys, we get a lot of drive-bys through our sign, and that's we have we automate the software on that. So
Yeah, you
yeah,
want to be, and even to take it one level deeper with self-storage, somebody might drive like a mile or two outside of town to go visit their self-storage unit. Somebody who's going to wash their car, they're going to be writing out grocery store, pick up dry cleaning, go get the, whatever, got repaired, at X, Y, and Z, auto parts store. And oh, by the way, get a car wash. It has to be in that driving pattern that they do every week.
oh, I see. So that's your micro level where you have to look, analyze the pattern, make sure it's clear, close by, and not too much competition. Yeah. So that's a hard part, right? Because it's the problem is the issue here, the risk is you don't know if the township will allow another car wash nearby, or there's no moratorium. So it's sort of like self-storage. It can kind of got a little oversaturated because there's no moratorium. And the township, when I complain to the township about that, it's like, oh, I got no real good feedback from that one. So now we are in competition with, quite a number of, newer facilities that need to fight the price war. So that's one of the issues I see. So yeah, be careful when you're a business like that, like more like a retail business. You have to be
Mhm.
careful of your competition and can you do it? Can you think about your price war too? Because you can't be priced higher than them, and then the customer go to other place. So that's the issue.
Yeah, you have to make sure that you provide immense value. And
Hmm.
with car washes, there's a little bit of, I wouldn't say like moratorium, but the city does get more involved because you have not only water usage, but also like the sewer, you have to take into account like reclamation of the water and cleaning of the water and like,
Mhm.
disposing of the water. So the city does get it a little bit more involved on like how
Yeah.
many locations are going to go in a certain area, but not enough to where they're going to say, "Hey, by the way, like we're oversaturated." Like, no
Yeah.
cities want taxes, so
Yeah, yeah. They're not for you, they're for themselves, for the taxes. So they're more pro tax. So okay, great. I mean, so what do you see now in the trend? I mean, if you were a passive investor now, what were you looking at? What would you want to invest in? What asset class? What you look at? And how do you feel the market's trending?
yeah. So I go back to I kind of think of this in the reverse order. So I'm taking a look at the market and kind of understanding what phase of the market are we in, and especially in the geographical location that I'm looking to invest,
Yeah.
right? We can say, hey, has the US been in a recessionary environment? That doesn't apply across the board in all geographical locales. So if I can boil it down to the regional level, like, where is that region? Are they in the hyper supply still? Does supply still need to be absorbed? Are they more in the recessionary, or have they kind of moved through the recessionary environment and gone into like more the expansion area,
Okay.
heading into hyper growth? So I'm taking a look at the market. Now, when you look at hyper supply and recessionary, markets,
Yeah.
areas that are still in those phases of the market cycle,
Okay.
that is very attractive because the credit has been sucked out of the environment. Banks aren't lending in those areas. So how can I be the bank? And so I love like, for me personally, I love investing in real estate debt funds,
Okay.
and, taking first lien positions, on residential real estate. That's my jam.
Good.
That's what I love doing. But this in certain markets, this could be the smart time to start getting into some equity assets.
Okay.
But you want to make sure that you're not getting into equity asset in a market that's still in the hypersupply phase, right? Because
Okay.
it's kind of like catching a falling knife. We want to be that the hypersupply has been absorbed, or it's gonna, when it will be absorbed, maybe in Q1, Q2 next year, and then you're moving through to the growth phase of the asset.
Okay.
And so things that I'm excited about debt right now. Debt's still going to be king. Cash flow is still king. I'm still building out that part of my portfolio.
Okay.
And then, multifamily, I think, as rates, we're expected to get another 50 basis point, or at least one this year, maybe another 25 or 50 early next year.
Okay.
I think the markets have already kind of started pricing part of that in, or
Okay.
they will do that pricing in after the election. I think,
Okay.
getting into high quality equity assets in markets that have moved through the hypersupply phase, it could be something that, people should consider adding back into their portfolio.
Mm-hmm. I'm bullish on multifamily. We just closed one and we're having it on the contract. So I'm kind of bullish on multifamily because we know that we can get assets and we can turn it around. I think we'll do very well.
Yeah. And
And
kind of like pull in something that you said earlier. I mean, not all classes cycle with each other. So just because we're, say, commercial real estate, multifamily has cycled faster or earlier. And I feel in a lot of markets, self-storage is now following right behind multifamily. So I feel
yeah,
like in a lot of markets, self-storage is starting to hit the hypersupply phase. And
yeah,
so, I'm kind of stacking up multifamily, maybe adding in some, cash flowing businesses over the
yep,
next couple quarters, and then
yeah.
maybe like in 12 months to 18 months, seeing where self-storage stands.
Yeah, I think you're right. I think for me as a self-storage operator, my goal is to sell by next summer all my portfolios in Texas because I feel like it's kind of like 2022 for multifamily where it's at a point where you gotta sell until might go back, it might go down afterwards, So because it's oversaturated, it's too many, and it's just like it's very hard. So I think my goal is effectively sell. And I was gonna hold maybe one that location for now. The only location I think that's pretty good is going on. So we can get back into multifamily and then look at more industrial triple net because I feel like the cap rates are relatively high right now. So if I get a price point, I can get good cash flow. Those are more long-term play that you can hold on long term. It's not like a short-term value of 3 to 5 years, more like a long-term play. So I'm hoping for those assets that we can grow and get good cash flow through. So and that's what they were telling me. So okay, that's great. So it's great. So what lessons you learned as a passive investor? Top three you think your advice as a passive investor you learned?
Wow, so many lessons and learnings. I think number one as a passive investor is you have to understand what your goals are today, in
Okay.
5 years, 10 years, and in 15 years, and start building out that 15-year portfolio now. And so if you're 15, 20 years away from a retirement, it can't all be about the equity assets. You have to have diversification. And so that's kind of like lesson number two is diversifying your portfolio way earlier than you think you need to,
Okay.
because you just never know when a black swan event like COVID's going to happen, or when interest rates are going to run up again. Are we going to hit a recessionary environment? So make sure that you have uncorrelated assets in your portfolio, and not just diversification in assets like self-storage, multifamily, express car washes, but even different layers of the capital stack.
Okay.
Don't be afraid to add in the debt layers now. Like this is the time to build the debt layer part of your portfolio. If you'll allow me to tell a 30-second story, I
Sure.
you know, started trying to answer this question for myself, like, can I like stand on the shoulders of like giants, like, well-known passive investors that are fully retired, and I started calling everybody, setting up meetings, and I was like, tell me your perfect portfolio allocation. Every single one of them laughed, not at me, but just laughed. And they were like, one, there's no perfect allocation across the asset classes.
Okay.
But they said, I learned to invest in what the market is giving me and get diversified across the different layers of the capital stack earlier than I thought I needed to. And they were like, once I learned that lesson, and it only takes one downturn to learn that lesson, they're
Hmm.
like, then I felt like I was more fortified. Nobody ever said bulletproof, but like, they could weather the storms of the market cycle.
Okay.
So know your goals, know your risk, know your timeline, get that diversification much earlier. And then the third is you have to, as a passive investor, it cannot be about the returns. It has to be about the operator. You
Okay,
have to
good. I like that. I
do
like
a
that. Yeah.
ton of due diligence on the operator.
I like that. I like that. I like that. The focus on the operator, not necessarily asset, even though the asset might be good, you might like the location, but know the asset operator track record, how he operates, how he communicate to you. Does he communicate monthly, quarterly? And how's his style? Do you fit? Do you like that? Stuff like that. And then you get a good sense of who they are. So
Mm.
good.
Honestly, like I've only lost on a couple of investments
Yeah.
in not just in real estate, but other cash flowing assets.
Yeah.
It's always been about the operator. It always boiled back down to the operator. And there was a clear red flag that I ignored, and I
The,
could have saved myself a
you,
world of
I
hurt.
think you look at the asset and the location, but not the operator, right? More so the asset and the returns. Is that what you focus
Or
on?
I would justify something else about the investment to be like, well, like, maybe this operator doesn't have exact experience in this particular asset class, but they've done really well in this other asset class.
Hmm.
Like that'll be okay. Like they'll figure it out. They got good
Yeah.
business sense. That maybe or maybe not. Or
Hmm.
maybe, yeah, I looked at the returns or I looked at the market or how quickly I was getting my capital back and just,
Hmm.
glossed over some probably pretty glaring red flags that, had I
Yeah.
paid
Yeah.
attention to would have,
Yeah.
um, you know,
Hmm.
clued me in to not invest with that operator.
Yeah.
But
Yeah. So
it's always 2020, so
yeah, I think it's 2020 because he could be a good he could be a new operator hungry and do very well too, and the market did very well. So by luck too, he did well by the market too. So it could be a combination of both, like multifamily time when it's still going up. I mean, everything's going up, so it's almost you can be new but you still do well, you know? You know what I'm saying? So I
Mhm.
mean, so it's kind of like you don't know until hindsight, effectively. So
Yeah.
yeah.
So, I mean, I know a lot of people have experienced a lot of pain with capital calls, paused distributions, unfortunately failed investments. Um, I love Tony Robbins like quote, like what is the world, what's happening for you here? Like try to put on that lens because if you can sit with that question and look at that failed investment, and just because you have a pause distribution or a capital call, that does not mean that your investment's failed. Okay. But like if
Mhm.
you've lost money, your investment's failed.
Yes.
Then take that information, that's lessons in learning, and feed that right back into your investment thesis so you don't do that again.
Yes. Yes. No, no, I understand. It's great. I know people had that and a lesson learned. And sometimes the black swan came and no one's foresaw the 11 times rate hike. No one saw COVID-19 either. So you have two double whammy back to back, right? First COVID, then that the collections was hurt because people couldn't pay the rent. And you try to get some CARES Act money. And when that ran away, then you had another issue. Then the interest rate spiked up and then your insurance cap ran out, or you had no insurance cap, then you had a big issue with that. So it's a lot of black swan that came out really fast and aggressive in a short time period.
Tripling of taxes, doubling of
Yeah.
insurance. Like,
Yes. Yes. I mean, some in Texas, the doubling insurance or triple taxes, the near Houston, the hurricanes,
mhm,
Galveston, Houston got hugely hit by the hurricanes. And
mhm,
I think in recent, unfortunately, Florida got hit by those two hurricanes recently. So I expect the insurance to go up, right, on those in Tampa area and those areas, and maybe in the whole part of Florida because the way that one of the company works, is that they burn everyone else. It's not
mhm,
just not one area. So it could be the whole area of Florida that could go up because otherwise they can't afford one sector and they can't afford all the costs in one sector, right?
mhm.
So yeah,
Yeah, and
so
they spread the
great.
costs across the whole state, unfortunately.
Yeah, I think that's how it works in Florida. And one of those, the company is kind of like a not, I think it's like government sponsored or something. So unfortunately that's gonna hurt the Floridians. And and investors, right? In like Jacksonville or in Orlando or in Fort Lauderdale, right? So you know, you guys, do you mainly invest in the Carolinas, or what do you guys invest in the passive investing?
Yeah, from the multifamily perspective, we love the Southeast. So we love North South Carolina. We have some assets in Georgia and Tennessee,
Hmm.
Florida. We have an asset in Texas.
Yeah.
We would love to expand into Texas, but right now, like the Southeast is, pretty much our mainstay. From a self-storage perspective, we'll venture out of that geographical area,
Hmm.
because we can get high quality third-party management that, manages multiple properties across the United States. And from our express car wash perspective, we stay primarily in the Southeast for now.
Okay. Okay, great. Thank you. So if we reach out to you, Whitney, don't want to get hold of you.
Yeah. Yeah. For anybody listening to the show, I've got some free goodies for you. You can visit passiveinvestingwithwhitney.com. There, you can jump on my calendar. You can also see our open deals.
Okay, great. Thank you. Thank you for coming on the show, Whitney. I appreciate it.
Yeah, thank you.